Viewers at home, you are welcome to my presentation on IAS 7 Statement of Cash Flows. In this presentation, I will examine the direct method of preparing statement of cash flows. I will explain the activities under which statement of cash flows can be prepared. I will give the format for preparing statement of cash flows. I will also explain how to arrive at each of the items that will be presented on the face of statement of cash flows. I will solve comprehensive work example from Kaplan ACCA study test. Please, if this is your first time of coming across my channel, or if you have not subscribed in the past, please hit the red subscribe button and turn on the notification bell icon so that you'll be able to receive a notification message each time I drop a new video. If you are a returning subscriber, I say thank you and God bless you. Statement of cash flows. Statement of cash flows. Statement of cash flows is a statement that shows the cash inflows. A statement that shows the cash inflows. By cash inflows, I mean cash receipts. And the cash outflows. Cash outflows. By the cash outflows, I mean cash payments of an entity over a given period of time. A statement that shows the cash inflows and the cash outflows of an entity over a given period of time is said to be the statement of cash flows. I repeat, a statement of cash flows shows the cash receipts and cash payments of an entity over a given period of time. If it shows the cash receipts and cash payments, that means the statement of cash flows is prepared in line with the cash basis of account. It is prepared in line with the cash basis of accounts. The minimum requirement for the preparation, minimum requirements for the preparation of statement of cash flows are one statement of comprehensive income. By statement of comprehensive income, I mean the statement of profit or loss and other comprehensive income. One statement of comprehensive income, that is one statement of profit or loss and other comprehensive income. Two statements of financial position. Two statements of financial position. 3, notes to the financial statements. Notes to the financial statements. These listed financial statements will be prepared in line with the accrual basis. And you want to use those information to prepare your statement of cash flows. Remember, I've told you that the statement of cash flows is prepared in line with the cash basis of account. That means you will be expected to convert the accrual basis financial statement to cash basis financial statement. You want to convert from the accrual basis to the cash basis. That is your focus under this. Although IAS 7 does not prescribe a format for the preparation of the statement of cash flows. IAS 7 does not prescribe a format for the preparation of the statement of cash flows. It does require the cash flows to be classified into, that is, in accordance with IAS 7, cash flows can be classified into these 3 headings. Number 1, we have operating activities. Operating activities. IAS 7 require the cash flows to be classified into this heading. Number 1, operating activities. 2, investing activities. 3, financing activities. These are the heading under which statement of cash flows can be prepared in accordance with IAS 7 statement of cash flows. This classification may require a particular transaction to be shown partly under one heading and partly under another heading. The classification may require one item to be shown under one heading and under another heading. Remember, I've given you these 3 headings. E.g., when cash repayment of loan includes both interest and capital. When the cash repayment of loans includes both interest and capital, the interest element might be shown as operating activity, while the capital element be shown as financing activities. So when the cash repayment of loans include both interest and capital, the interest element may be shown as operating activities, while the capital element may be shown as financing activities. Definition of terms. Definition of terms. Definition of terms. Definition of terms. Number 1 term I'm going to examine is cash. Cash. What do we mean by cash? Cash comprises cash on hand and on-demand deposits. It comprises cash on hand and demand deposit at the bank. That is the makeup of the cash. Cash comprises cash on hand and the demand deposits. Number 2, we have cash equivalents. Cash equivalents. Cash equivalents are short-term, highly liquid investments. Short-term, highly liquid investments that are readily convertible to no amount of cash. Short-term, highly liquid investments that are readily convertible to no amount of cash and are subject to an insignificant risk of changes in value. That is cash equivalent. The 3rd term I'm going to look at is operating activities. Operating activities. Operating activities are the principal activities of the business. The principal activities of the business are said to be the operating activities. I repeat, operating activities are the principal activities of the business. They are the activities that arise in the normal course of business. Operating activities are the activities that arise in normal course of business. That is operating activities. Operating activities, I repeat, I said they are the activities that arise in the normal course of business. Example of these activities are cash received from customers. No, every businesses are expected to sell. When you sell, you receive cash. Cash received from customers. This is normal to business. This arises in the normal course of business. Then when you buy goods, you pay the suppliers. Then we have cash paid to suppliers. Cash paid to suppliers. Number 3, we have other cash expense. Other cash expenses. Other cash expenses. So under this you have the distribution expenses, and the administrative expenses. This fall under this administrative expenses. Remember your financial statement. These expenses will be found in the statement of profit or loss, which will be prepared in line with accrual basis. Then that means these expenses will have been reported in accordance or in line with accrual basis principles. Then you want to convert it to cash. That means the accrual items have to be removed. And examples of items that will be reported in the financial statement in line with the accrual basis principle is, number one, we have the depreciation. Number two, we have the impairment. That means you have to eliminate depreciation. You have to remove items such as depreciation. You have to remove them from these expenses. You have to remove items such as impairment loss, where they have been included. Only where they have been included. I mean, where these items have been included in either distribution expenses and administrative expenses, that is when you will require the adjustment. That is when you will need to eliminate them from it. Where they have been charged to cost of sales, that means you will not need to remove them from this. Where these items have been included in the cost of sales, you don't need to remove them from your distribution expenses. That means the adjustment that will be required will have to be made in our cost of sales when you are calculating the cash paid to the suppliers. Then when you have loss from disposal of an asset, loss on disposal of non-current assets, where these have been included in either distribution expenses or administrative expenses, and you want to convert from accruals to cash, then you will need to remove it. Profit from disposal of assets. Profit from disposal of assets, of non-current assets. NCA means non-current assets. Where that profit have been included in administrative expenses or distribution expenses, then you will need to remove them from it. When you are converting from accruals to cash, please take note of that. Now, I am still on those items that will be reported as operating activities. Remember, I've told you that operating activities, I said they are the activities that arise in the normal course of business. I've given you examples of those items to include cash received from customers, cash paid to suppliers, other cash expenses. Then number 4, then the taxes. Every businesses are obligated to pay tax. So taxes paid is an operating activity item. So I have given you the examples of those items that will fall under operating activities. The second heading I'm going to look at is investing activities. Investing activities. That is the second heading. Investing activities. Investing activities are the activities that arises from the changes in non-current assets and investment. Activities that arises from changes in non-current assets, changes in non-current assets, NCA, non-current assets, and changes in investment. Changes in investment or investment income. So meaning that the moment you get to the investing activities, you just go to your statement of financial position, you determine or you calculate the changes in your non-current assets. You know, your non-current assets include the property, plant, and equipment. Property, plant, and equipment. That means you will need the movement in property, plant, and equipment. So then the movement in property, plant and equipment. What will bring about changes in property, plant and equipment is one, where there is an acquisition. So you have purchases of property, plant and equipment. When more property, plant and equipment is bought, then the property, plant and equipment will change. That is, it will increase. Then where there is a disposal of non-current assets, then the PPE will change. Then you have the proceeds. It is the proceeds that involve cash. Proceeds from disposal. By proceeds, I mean the amount realized from the sales of PPE. Proceeds from disposal of property, plant and equipment is an investing activity. Then remember, intangible asset is also part of your non-current assets. So no, I've told you that investing activity deals with changes in non-current assets and changes in investment. Investing activities, so when you intangible assets is part of your non-current assets. So purchase of intangible assets. Purchase of intangible assets. Then you may also have changes in investment where there are purchase of money investment. Purchase of investment. You know your investment is still part of the non-current asset. I mean the long-term investment, not the short-term. The long-term investment is part of non-current asset. So, but short-term investment could be current asset. And where it is current, that means if it meets the definition of cash equivalent, you are going to have it as cash equivalent, not as investing activities, where you have your investment under current asset. If it meets the definition of cash equivalent, then you are going to report it as cash equivalent. Then investment, you may have income from investment. So in form of dividend received from investment. Then when you give out loans in form of investment, then you receive interest received on loan given out. Interest received is an investing activity. Then proceeds from government grant, where there is a government grant. Proceeds from government grant. Proceeds from government grant. Proceeds from government grant. That is investing activities. The third heading I'm going to look at is financing activities. Financing activities. The third heading is financing activities. Financing activities. Then these are activities that arises from the way the business are to be financed. It arises from the ways the business are to be financed. That means the business will be financed from the business may be financed with the composition of both the equity and debt. The business may be financed with both equity and debt. By debt, we mean the long-term borrowings, long-term debt. So, these activities, I said they are activities that arises from the way the business are to be financed. I'm told that the business might be financed with the composition of equity and debt. So, financing activities are activities that arise from the changes in equity and long-term borrowings. Financing activity are the activities that arises from the changes in equity and the long-term borrowings. Examples of financing activities are: 1. We have proceeds from issue of shares. Proceeds from issue of shares. Issue of shares will fall under this heading. Number 2, we may have proceeds from long-term borrowings. Proceeds from long-term borrowings. Proceeds from long-term borrowings. Then you may also have payment of lease liabilities. Payment of lease liability. Payment of lease liabilities is an example of financing activities. Then we also have dividend paid. Dividend paid is also an example of financing activity. Having given the examples of those items that will be reported as financing activity, I therefore want to give the format for the preparation of the statement of cash flows. Format for preparing statement of cash flows under the direct method. So format for preparing statement of cash flows. So format. Let us say you have XYZ Limited statement of cash flows for the year ended. For the year ended December 31st, 22x. Statement of cash flows for the year ended December 31st, 22x. So, let's assume the currency is dollar. Then you may have notes. Remember the first heading should be the operating activities. Operating activities. I've given you the examples of items that will fall under this heading. Number one is cash received from customers. Cash received from customers. This item will not be given. The amount involved will not be given because examiner may not give you the cash item. So they may want you to look for it yourself. Remember, I've told you that the minimum requirements for the preparation of statement of cash flows are one statement of profit or loss and other comprehensive income, and two statements of financial position, three notes to the financial statement. This cash received from customers, you receive cash from customer when you sell goods. That means the amount you receive from customers is your focus here. Then what are the transactions that have to do with customers that will be found in the financial statement? Number one, you might have receivables. Receivables will be found in the statement of financial position under current assets. Then revenue has to do with the customers, and revenue will be found in the statement of profit or loss. Then you may have bad debts. Bad debts, if any, bad debts. And you may equally have discount allowed. Discount allowed. If two statements of financial position is given, you have to ascertain which one is the opening and which one is the closing. You may be given 20x9 and 20x8. Where 20x9 and 20x8 are given, 20x8 is opening. Any figure, that means if I say opening balance, that will be found in the opening statement of financial position. If I say closing balance will be found in the closing statement of financial position. I want you to take note of that. And sometimes the closing may not be the one you are going to have here. So you might have 2020, and let me say 2020 and 2021. You have to wash out the date or the year. The 2020 is the opening, while 2021 is the closing. I want you to bear this in mind. Anytime I say the opening balance, that means Your both opening and closing balances will be found in the statement of financial position. In all my workings, I will always start with the opening balance. Now you want to calculate the amount of cash you received from customers. Then you prepare the receivable ledger control account. Cash received from customers, working one. So this is how we are going to arrive at the amount that will be reported as cash received from customers. So cash received from customers. Cash received from customers. Remember, I've told you that we'll be starting with the opening balance. Opening balance. I've told you that your opening balance will be found in the opening statement of financial position. The opening balance you need here is the receivable. The receivable, and the receivable will be found in the opening statement of financial position. This receivable is the amount you are owing your customers as at the beginning of the accounting period. Let us assume you are owing the customer $100. And I'm assuming that $100. Let us assume that is the amount you are owing at the beginning of the year. You are owing $100. We have an assumption in account that unless you are told it is cash, all transactions in account are assumed to be on credit. Unless the question says cash says. If they didn't put cash there, you know that it is on credit. Then you have to work to arrive at the cash because you want to prepare your statement of cash flows in line with the cash basis of account. So you have started with the opening balance. That is the amount you are owing with the customers at the beginning. The amount your customers are owing you at the beginning of that trading period. Then you now have your revenue. Your revenue, unless you are told it is cash, you don't need the cash revenue here. Or even though you include it, no problem. But unless you are told it is cash, you know that it is on credit. All your revenue should be on credit. That means you are owing, let us assume your revenue is 500. This is the amount of goods you sell on credit again. Remember you were owing customers the sum of 100 before, $100, and you now sell more on credit for $500. That means the amount the customers are owing you, customers were owing you $100 before, and you also sell, you make further sales on credit, which the customer hasn't paid for. That means when you sell 500 on credit, the customers are now owing you $600. So now we have dealt with opening balance of the receivables. We've dealt with revenue. Then the next one is bad debts. Bad debts. Bad debts are irrecoverable debts. Bad debts are irrecoverable debt. Maybe the customers owing that debt has disappeared, or the customer has died, and that customer is of nowhere to be found. The amount the customers are owing will be written off because they cannot be recovered. So since it will be written off, you are going to remove it from the amount the customers are owing. Maybe $50 becomes bad. You have to remove it so that from 600, the customers were owing you 50 is bad. That means what they are owing now, the good debt now is 550, no longer 600. So that is bad debt. Then discount allowed is the next one. Discount allowed is the allowance you give to customers for prompt payment. Allowance given to customers for prompt payment. This discount allowed is a form of rebate. Discount allowed is a form of rebate. Therefore, when you give discount to customers, that means the amount the customers are owing will reduce. So you have to subtract it. Then let us assume this is $20. That means out of 600 now, 100 plus 500, that is 600. 550 is bad. That means you'll be left with 550. And 20 is discount. That means out of 550, then the amount you are expecting from customers is 530. So when you are expecting 530 from customers, in your closing entry, that is your closing statement of financial position, you will also see your receivables there. So now I want to put closing balance. Closing balance. That is your closing balance of receivable. That means the amount the customers are owing you as at the end of the period. You have to subtract the closing balance. Let us assume the closing balance is $130. Now, this is what the customers are supposed to be owing you. They are supposed to be owing you $530, and you now have $130 left. That means you have received certain amount from customers, which amounted to $400. So that is the amount of cash received from customers. It is this amount now, that is your cash received from customers, that will be reported as operating activity in your statement of cash flows. That is working one. Cash received from customers is an inflow. You are receiving it, so it is an inflow of cash. The next one is cash paid to suppliers. Cash paid to suppliers. Let me have that to be note 2. Now, where will you see transactions that have to do with the suppliers in your financial statements? Transactions that has to do with supplier will be found in one, statement of profit or loss. You will see your purchases will be in your statement of profit or loss. Remember, this is a published financial statement, so you will not see purchases there. So, but you will see cost of sales. This is your cost of sales. Your purchase is part of the cost of sales. What you need is not the cost of sales, but the purchase. So that means you will need to work back to get your purchase, to get your purchases figure for the period. You need to work back your cost of sales. Remember, to get cost of sales, your cost of sales is opening inventory, opening inventory plus purchases minus closing inventory This is closing inventory. This is what gives you cost of sales. Opening inventory plus purchases minus closing inventory gives us cost of sales. That means opening inventory plus purchases minus closing inventory, if it is equal to cost of sales, then to get your purchase, you work back. You make your purchase the subject of the formula. That means your purchase will now be equal to your cost of sales. Purchase equal to cost of sales. Then when you take this to go and join it at the right hand side, the minus here become plus closing inventory. Then when you take your OI is your opening inventory. When you take it to the right hand side, this is plus before it becomes minus opening inventory. That means our purchase equals to cost of sales plus closing inventory minus opening inventory. So you have arrived at your purchases figure through this model. Please take note of this. Then aside purchases, your payment to suppliers, then you may have payable in your statement of financial position. Your payable will be there. I've told you that your trade payable you may have in your opening statement of financial position and the closing statement of financial position. So take note of that. Then you might have discount received. And if this is in the question, you'll be given by the way of note to the financial statement. Now, these items now, you now want to use them to arrive at your cash paid to suppliers. You want to calculate cash paid to suppliers. Now let me have that to be note 2. Note 2, which is cash paid to suppliers. So remember, I've told you that you should always start with the opening balance. So you are starting with the opening balance. I've told you that your opening balance will always be found in the opening statement of financial position. So opening balance. The opening balance this time around is not receivable but payables. And your opening balance of payables will be found under current liability in the statement of financial position. Then plus purchases. You want to add your purchases, but remember I've told you that your purchases will not be given directly. Then to get your purchases, I said you take your cost of sales. Your cost of sales. Then after cost of sales, you add closing inventory. You add closing inventory to cost of sales. Closing inventory. You add them to cost of sales. Then after adding the closing inventory, you less the opening inventory. After this adjustment, then you arrive at your purchases. This amount will be your purchases where there are no unusual items included in cost of sales. Sometimes you may be told that depreciation policy is to charge depreciation to cost of sales. Where you see the policy of the organization is to charge depreciation to cost of sales, that means you will need to remove depreciation before you can get your purchases. Depreciation, where the policy of the organization is to charge depreciation to cost of sales, you remove depreciation. Then impairment loss, you remove it. Then loss from disposal of non-current assets. Loss from disposal of non-current asset, you remove it. And if it is profit from disposal of non-current asset, you add it. This is what will give you the purchases. I put an asterisk in these items. These items will only be adjusted when you are calculating your cost of sales, where the depreciation policy is on cost of sales. And where the depreciation policy is not on cost of sales, then you will not require this adjustment. You will not need to remove them. You will not need to adjust for these items. You only need to adjust them where the depreciation policy is cost of sales. Remember your payables, then your purchases, and if you have your discount received in the questions, discount received. When you receive discount from the supplier, that means the amount you are owing the suppliers will reduce. Then as usual, you remove your closing balance. Your closing balance I'm talking about is your closing balance of the trade or account payables. So after that, then you get the cash paid to suppliers. You get the amount of cash you have paid the suppliers during the period. That is how you are going to get the amount that will be reported here. You are paying the suppliers. So this is an outflows of cash, and that is an outflows of cash. Then the third item I'm going to look at is other cash expense. Other cash expenses. Let me have that to be note 3. Other cash expenses. You are going to work it out as well. Note 3, and that is other cash expense. So I've told you that under this you have distribution expenses. Then you have administrative expenses. Then I've told you that where these expenses include an accrual based item such as depreciation, that since depreciation follows the accrual basis, you are going to remove depreciation. I asterisk that because if the depreciation policy is cost of sales, then you will not need to remove that depreciation from this. You only remove depreciation where it has been included here. That means adjustments for depreciation to make must be made where they have been included. Then where depreciation policy is cost of is in distribution or administrative expenses, that means impairment loss follows the same principle. So your impairment loss will be removed as well. Then loss from disposal of an asset follows the same principle. Loss from disposal of non-current assets follows the same principles. Then profit from disposal of non-current asset, profit from disposal of non-current assets, you add the profit. This adjustment, these items are asterisked, will only be made when calculating other cash expense where they have been included in either distribution or administrative expenses. You'll be told where depreciation policy. The examiner may be silent about the policy. And where the examiner is silent, you know that depreciation policy is on administrative expenses. But where they tell you that depreciation, they used to charge it to cost of sales, you have to follow the principle. Other items that will need to be adjusted in other cash expenses are items of accruals and prepayment. Remember, when preparing statement of profit or loss, accruals will have been added to the expenses reported in the statement of profit or loss. So where you have an accruals will be found under current liabilities in the statement of financial position. It may be called accrued expenses or accruals or other payables. So we add opening accruals. We add opening balance. Accruals. I've told you that accruals may be called other payables. So if you see other payables there, you know that it is the same as accruals. Then you less closing balance of accruals. Closing balance of accruals. You less the closing balance. Then prepayment too may be adjusted in the other cash expenses. So the opening balance of prepayment is the opposite of accruals. Opening balance of prepayment will be, so since the opening balance of accruals was added, that means opening balance of prepayment will be subtracted, while the closing balance of prepayment will be added. Closing balance, this is prepayment. This is prepayment. So after this adjustment, you arrive at the amount of expense, amount that were paid. And this is the amount that will be reported in a statement of cash flows. Statement of cash flows. Then you report this amount there. It is an outflows of cash, so that is why I put it in braces. I put it in braces because it is an outflows. Then, after this adjustment, you have this. And this could be plus or minus. Where payment exceeds the receipt, it will be negative. And where receipts exceed payment, then it will be positive. Then the next thing is interest paid. Interest paid. That is note 4. Interest paid. Interest paid. Note 4. Note 4. That is interest paid. Interest paid. That is note 4. Then the items, you might have interest payable in the statement of financial position under current liabilities, and you may be given by the way of note, because it might have been included in other items, and you will now be told in the note that this maybe your payable include interest payable of this amount. So interest payable now, the opening balance is what you start with. Opening balance. Your opening balance, that is interest payable. That is your opening statement of financial position. Then you have finance cost. Finance cost, that is statement of profit or loss. Your finance cost from statement of profit or loss. Statement of profit or loss. Your finance cost will be added. Then you less your closing balance. Interest payable. Closing balance. That is interest payable. Don't forget, I've told you that your closing balance will be found in the closing statement of financial position, while the opening balance will be found in the opening statement of financial position. This amount is what we are going to report here. So you have it here. You remove it. Then after that, then you have the next item is taxes paid. Taxes paid. Note 5. Taxes paid. That is note 5. Then your tax information will be obtained from the statement of financial position under current liability and under non-current liability. Under current liability, you have income tax payable there. Under non-current liability, you have deferred tax. Current liability and non-current liability, you will have tax information there in your statement of financial position. Then in your statement of profit or loss, then you have tax expense before you arrive at profit for the year. And then you may have tax attributable to the fair value gain in other comprehensive income. So taxes paid. I've told you that you see tax information in both current and non-current liabilities and the statement of profit or loss. So taxes paid now, working 5. That is note 5. Taxes paid. Don't forget, you start with the opening balance as usual. Opening balance. I've told you that your opening balance and closing balances will always be found. Opening balances and closing balances will always be found in the statement of financial position. Then you have opening balance now. Opening balance, that is opening balance. You will have income tax provision or income tax payable. The one that will be found under current liability. This will be found under current liability. I'm talking about its opening balance. Then that of deferred tax, the opening balance under non-current liability. Then you have tax expense in the amount of tax that was expensed in the statement of profit or loss. That is that. Then you sum up this. You have this as the total. Then you less closing balance. Your closing balance can also have income tax payable, just like this. Then and the deferred tax, the closing balance. So the total of the closing balances is this. When you remove the closing balances, when you subtract this from this total, then you get the taxes paid. It is this taxes paid that will be reported as operating activity here. Then you report it as operating activity. Then when you have this minus this minus this, Then you get net cash flows from operating activities. Net cash flows from operating activities. Net cash flows from operating activities. It could be positive and it could be negative. Where payment exceeds receipt, it will be negative, and where receipt exceeds payment, it will be positive. After operating activity, the next heading is investing activities. Investing activities. I've explained investing activities earlier as an activities that arises from the acquisition and disposal of non-current assets, or activities that result in or from changes in non-current assets and investment. I have told you that whenever you get to investing activity, you are going to check the movement in non-current assets. So we have on the items that will affect the non-current asset. You may have PPE in both statements, in your statement of financial position, both opening and the closing. You might have your PPE there. Then apart from that, depreciation might affect your PPE. Depreciation. Then you might have disposal of PPE. You might have acquisition or purchase of PPE. You might have revaluation of PPE. Your PPE might be revalued, which might lead to revaluation surplus or revaluation deficit. You might have revaluation surplus or fair value surplus or fair value gain and revaluation deficit. These are those items that may be adjusted in our PPE. So now, I've told you that whenever you want to calculate, you might have purchase of PPE, you might have proceeds from disposal of PPE. But let me start with the purchase or acquisition of PPE. Let me start with the purchase of PPE. Then this purchase will be calculated from the movement in PPE. That is note 6. Note 6, you have movement in property, plant and equipment. As usual, you want to start with the opening balance. Your opening balance, which will be found in the opening statement of financial position, opening balance of PPE from the opening statement of financial position. The PPE may be acquired through lease, acquisition, through lease. When you acquire lease, you acquire another PPE, the fair value of the one you acquire through lease will be added. Then depreciation, where there is a depreciation, the PPE will reduce. You will subtract the depreciation, so PPE will reduce. And where PPE is impaired, impairment loss, the PPE will reduce where it is impaired. Then, where it is revalued, you can have revaluation surplus. And where there is a revaluation surplus, the PPE will increase or fair value gain. And where it is revalued downwards, revaluation deficit or fair value deficit or fair value loss, PPE will reduce. Then disposal of PPE. Disposal of PPE. Where PPE are disposed, PPE will reduce. Where they are disposed, it will reduce. But it is the carrying amount. Carrying amount. Remember, carrying amount is cost less accumulated depreciation to the date of disposal. PPE will reduce. So you subtract the carrying amount of PPE disposed. After this adjustment, you have this. Then you less closing balance. Closing balance. of PPE. When you subtract closing balance, it will be, then the difference will be purchase of PPE. Purchase of PPE. It will, if the closing exceeds this, that means more PPE have been bought. It will be negative where there is or a purchase of PPE. So it is this purchase you are going to report as an investing activity. Purchase of PPE. That is note 6. Then it is an outflows of cash. So you put it in braces. It is an outflows where you purchase PPE, then more cash will leave the entity. Then the next item is the proceeds from sales of PPE. Proceeds from sales of PPE, and this may be given in the note. Proceeds from sales of PPE. It may be given in the note and it may not be given. It may be given and it may not be given. Where it is not given, then you are going to calculate it like this. Note 7. So, note 7. Proceeds from sales of PPE. Then you start with the carrying amount of the PPE disposed. Carrying amount of PPE disposed. I've told you that the carrying amount of the PPE disposed will be the cost of the PPE disposed less accumulated depreciation attributable to the PPE disposed from the date of its acquisition to the date of disposal. Then remember where PPE are disposed, it may be sold at a profit or at a loss. Where it is sold at a loss, you subtract the loss from disposal of PPE. Loss from disposal, that means the proceed is less where it is sold at a loss, so you subtract. But if it is sold at a profit, you have profit from disposal of PPE. You add the profit, then you get the proceeds from the disposal of PPE. It is this proceed now that will be reported here. I've told you that it may be given directly in the question. Yeah, but where it is not given, that is when you will be required to ascertain that using the format I have given you, using this format. So, working 7 format. 8. Purchase of intangible assets. I'm still under investing activities. Investing activities. Purchase of intangible assets. Intangible asset, note 8. Purchase of intangible assets, note 8. Remember, an intangible asset are an identifiable non-monetary assets without physical substance. That is IAS 38. Intangible asset is an identifiable non-monetary assets without physical substance. That is IAS 38. So, let me have note 8. Then, we want to calculate the amount paid on purchase of intangible assets. Purchase of intangible assets. You are starting with the opening balance. Opening balance of intangible assets. The one in the statement of financial position, intangible assets. The opening balance as per the opening statement of financial position. Then you have the amount written off or impairment. Intangible asset may be impaired. Amount written off or impairment of intangible asset. Impairment. So you remove that. Then you have this. Then you now have the closing balance. Closing balance, that is your intangible asset. Then where the closing balance is not greater than this, where this closing balance exceeds, that means more intangible asset has been bought. So this amount is what you are going to report as an investing activities here. That is note 8. Then the next term is purchase of long-term investment. That is covered in IAS 40, investment property. Purchase of long-term investment. Let me have that to be note 9. And this long-term investment, purchase of long-term investment will be determined using the format on note 9, where it is not given. Note 9. So you want to calculate purchase of long-term investment. Purchase of long-term investment. So you start with the opening balance as usual. Opening balance, this will be found under non-current assets. Opening balance, that is of your long-term investment. You start with the opening balance. After the opening balance, you may have the fair value gain. Fair value gain, and this may be reported by the way of note you add if it is fair value gain. But where you have the fair value deficit, then you subtract the fair value deficit. After this adjustment, you have this. Then you now compare with the closing balance. Closing balance, that is long-term investment under non-current asset. So, where the closing balance exceeds, where the closing balance, this closing balance, where it exceeds, that means more of the long-term investment have been bought. And this amount is what you are going to report as the purchase of long-term investment under investing activity. Then, the next item is proceeds from sales of investment. Proceeds, where long-term investments are sold, then you have the proceeds from sales of investment. Proceeds from sales of long-term investment. Proceeds is an inflows. So you report that as an investing activity. Then the next item is interest received. Remember, I've given you interest receipt as part of those items that will be reported as investing activity. I am still on investing activity. Then we have interest received. Interest received. So now let me have that as note 10, where this is not given. So you may need to work it out. You check your current assets in your statement of financial position. Your current assets in your statement of financial position. You may have the receivables there. Your receivables may be there. So Now, note 10. Or you may be told by the way of note, they might put it under receivable. Then you will now be told that other receivable include interest receivables. So it may be given like that. Now you want to calculate interest received. Interest received. If you follow this format, there won't be any question on statement of cash flows involving direct method that you won't be able to solve. So this format is comprehensive, it is all embracing. So it covers everything you may be asked. Now, interest received, that is the one I want to calculate now. Then you start with the opening balance as usual. Opening balance. That is your interest receivable. Interest receivable. Interest receivable. I've told you that this might be found under current asset. Then you now have finance income. Finance income or interest income. Finance income or interest income. Interest income. This will be found in the statement of profit or loss. Another comprehensive income. Then you now sum up this. You have this at the total. Then you now remove your closing balance. Closing balance, that is your interest receivable under current asset. I've told you that your closing balance will be in the closing statement of financial position. So when you subtract that, this amount will be your interest received. And that interest received is what you are going to report as investing activity. Investing activity. Inflows. After that, after interest received, you may also have dividend received. Dividend received. Dividend received. Now let me have that to be note 11. It may be given, and where it is not given, then you are going to determine that using this format. That is work 11. I am about to give you now. Note 11, dividend received. Dividend received. And this will be determined just. Then you may have dividend receivable under current assets. So you start with the opening balance. As usual, opening balance, which is dividend receivable. Dividend receivable. Then we now have dividend or investment income. This will be obtained. Dividend income or investment income. This will be obtained from the statement of profit or loss. Another comprehensive income. Then you now have the closing balance. Closing balance. Closing balance. Then when you remove the closing balance, then you have the dividend received. And this is the amount you are going to report under investing activity as dividend received. Then the next item, I'm still on investing activity. The next item under investing activity, which I'm going to consider, is the proceeds from government grant. Proceeds from government grant. This may be given and it may not be given. And where it is not given, and information on government grant is given in the question, then you are going to determine the amount received using the format on note 12. Proceeds from government grant, that is note 12. Proceeds from government grant, note 12. Note 12. Proceeds from government grant. Proceeds from government grant. That is note 12. So you want to determine this. Then information about government grant will be found in the statement of financial position and the statement of profit or loss, which will be given by the way of notes. So now you start with the grant income. Grant income, grant income given in the statement of profit or loss or by the way of note. Then you now add closing balance. You used to have the payable, you have the opening balance, current liability. Then you add the closing balance. Closing balance of grant liability. The one closing balance grant liability, let me include it here. Grant liability. The one shown as liability, the closing balance. So, and this one you may have under non-current liability. The one under non-current liability, and the one under current liability. CL is the current liability. So you add the closing balances. Then you less opening balances of grant liability. So, when you add this and this, you have this total. Now less opening balances, that is grant liability. The one under non-current liability as well, and the one under current liability. The total of these two is this. When you now remove it from this, then you have the grant proceed from government grant received. So when you remove this from this total, then you have this. That is the proceed that will be reported as investing activities. Investing activities. Then you now cast everything you have under investing activities. You add everything together. When you sum it up, you have net cash flows from investing activities. Net cash flows from investing activities, which is the addition of all this. Then you have, it could be positive, it could be negative. It will be positive where the receipt exceed payments, and where the payment exceed receipt, it will be negative. That is net cash flows from investing activities. The next one is the third heading, which is financing activities. Financing activities. I've told you that financing activities result in changes in equity and long-term borrowings. Meaning that whenever you get to the financing section of the statement of cash flows, then you are going to deal with the movement in equity. Then the movement in equity may result in issue of shares, issue of shares, and debenture. So you are starting with, let me have issue of shares. Issue of shares. That will be determined using the format in note 13. Format 13. Issue of shares. Issue of shares. You start with the opening balance. The opening balances. Your opening balance of share capital, ordinary shares, opening balance of share premium. Then you may have bonus issue, and there may be no bonus issue. Where bonus issue are made from share premium. Information about the bonus issue should totally be ignored. Where bonus issue are made out of share premium, you ignore the information relating to the bonus issue. But where bonus issue are made from retained earnings, bonus issue out of retained earnings, you add. Then after this you have this. Then you have closing balances. Then you have share capital. Closing balances of share capital and that of share premium. After considering the closing balances, the total of the closing balances are these. When you remove the closing balances from this total, then you have this as the balance will represent issue of shares. And this issue of shares will be considered as financing activity in our statement of cash flows. Issue of shares. I am still on financing activities. Then under this, you might have proceeds from long-term borrowings. Proceeds from long-term borrowing. Proceeds from long-term borrowing, that is financing activity. Then you may have repayment of long-term loans. Repayment of long-term loans. Repayment of long-term loans. You compare the closing balance with the opening balance. Repayments and outflows of cash. Then we have payment of lease liability. Payment of lease liability. Let me have that as note 14. Payment of lease liability, note 14. And then this will be determined. Just payment of lease liability, you are going to determine that like this. Note 14. Payment of lease liability. We are going to start with the opening balance. Opening balance of lease obligation. Lease obligation. Your lease obligation, you may have one under current liability. And you may also have another one under non-current liability. You start with the opening balances of lease obligation, the one under current liability and the one under non-current liability. Then we also have lease assets acquired. The fair value of lease assets acquired, you add that. Then you now less the closing balances. You less the closing balances of lease obligation. Closing balances of lease obligation. The one under current liability and the one under non-current liability. After deducting the closing balance, then you arrive at the payment under the lease. You have lease payment. So this will be the lease payment. This lease payment, you are going to bring it down. You are going to report that as financing activity. It's an outflows of cash. Then we also have dividend paid. Dividend paid. And this may be given. And where it is not given, you are going to determine it using this format. Note 15. We have dividend paid. You start with the opening balance. No dividend will be paid out of retained earnings. Opening balance of your retained earnings. Dividend will be paid out of the retained earnings. You start with the opening balance of your retained earnings. Then we now have profit for the year. Profit for the year. Profit for the year, which will be obtained from the statement of profit or loss. Then when you sum it up, you less closing balance. Closing balance of retained earnings. Retained earnings. Then after this, the net difference is the amount of dividend paid, which will be reported as financing activity. Financing activity. That is dividend paid that will be reported as financing activity. After all this adjustment, you get net cash flows from financing activities. Net cash flows from financing activities. It could be positive or negative. Where the receipt exceeds payment, it will be positive. But where the payment exceeds the receipt, it will be negative. Then you are now going to sum up the balance obtained. That is your net cash flows. Net cash flows. Cash flows from operating activity we've obtained, plus the net cash flows. You have the net cash flows from operating activity, this one, plus the net cash flows from investing activities, plus the net cash flows from the financing activities. After the sum of the three, you get the net cash change. Net cash change. To this net cash change, you now add cash or cash equivalent at the beginning. at the beginning of the period. When you add that, then you get cash or cash equivalent at the end of the period. At the end of the period. Because of our time, I may not be able to solve work example in this one, but the next part, I'm going to give you a solution to a comprehensive work example. After watching this, just try to watch it. The title, I will still put statement of cash flows, direct method, work example. I will put it as a title. So you should be expecting that from me. Thanks.